Munk-Rotman Green Capital's approach to building a Canadian-focused sustainable finance equity portfolio. We appreciate your time and look forward to sharing our insights. We'll begin by introducing our team and outlining the challenge, providing key context on the Canadian economy. Next, we'll explore the climate and ESG considerations, our investment methodology, and the growth trends shaping Canada's sustainable sectors, all leading into a deep dive into our portfolio. Finally, we'll conclude with our engagement strategy and a summary of our investment policy statement tailored for investors. Guiding you through today's challenge are Zugo, Suniti, Keshav, Sydney, and myself. Together, we bring a diverse expertise in sustainable finance, investment strategy, and economic analysis. Our task is to construct a $100 million actively managed Canadian ESG equity fund designed for an investor with a strong growth appetite, moderate risk tolerance, and a long-term investment horizon. Some key parameters that we'll have to follow are tracking the market using the S&P TSX index as a benchmark and capping single asset concentration at 10% to ensure diversification. I'll now pass it off to Keshav to walk you through some Canadian context.
Awesome. So to start, let's look at a quick snapshot of key economic trends. Canada remains a top investment destination due to low corporate taxes and incentives for development of clean technology. However, challenges like regulatory complexities and ongoing trade disputes persist. On inflation trends, we saw rates stay low during the pandemic, then surge before stabilizing around 3% with expectations of further declines. Labor markets have been volatile with unemployment back up to 6%, while high immigration continues to expand the Canadian workforce. Lastly, on interest rates, aggressive cuts during the pandemic made borrowing easier, but sharp increases in 2022 aim to cool inflation in real estate markets. Looking ahead, a gradual decline is expected, with the stabilization happening around 3%. These factors help shape Canada's economic landscape and frame some of our upcoming investment decisions. I'll pass it over to Sydney to talk about climate risk.
So now on to climate risk. So this can be split into two different types of risk, physical risk and transition risks. So physical risks are due to the physical impacts of climate change and degradation due to climate change, and this can include both acute and chronic risks. And transition risks are more driven by government climate policies, technological changes, and consumer preferences that are involved in the shift to net zero. And transition risks are very important. Specifically, the preparation for a global low-carbon transition will determine company survival, and the impact of transition risks on profitability in 2050 is shown on the graph to the right as by sector. And as you can see, the transition will present opportunities for some sectors such as batteries and storage, as well as wind and solar equipment, and lower profits for others such as coal and oil. However, there are also many companies and sectors that could go either way depending on the actions that they take. And physical and transition risks both impact traditional risk categories or principal risks, including credit, market, liquidity, insurance, operational, and reputational risk. And on the next slide, I'll be going through the material ESG issues. So there are also material ESG issues, or MEIs, which refer to the ESG factors most relevant to a company's financial performance and risk profile. These vary by industry and are also chosen based on their impact on business operations, regulatory compliance, and long-term value creation. In a report by Sustainalytics, two key takeaways were found regarding material ESG risks, which were relevant for this case. First, human capital, business ethics, and product governance emerged as the most relevant MEIs across industries, as shown on the left. Second, environmental regulation was the most significant industry trend. Other key trends included digitalization and cybersecurity, and sustainable products and services, specifically decarbonization, sustainable fuels, and green substitutes were very important. And on the next slide, I will be going through our investment methodology, and we take a layered approach, including industry growth, ESG score, and financial ratios. At the core of our investment methodology is a simple idea that great investments are not just about strong financials, but they need to be built for the future, taking all of these risks into account. Our approach makes sure that every company in our portfolio is both financially solid and prepared for these risks. So we start with the fundamentals, looking at companies with strong earning potential and that are growing in a way that's actually sustainable. We first screened industries based on if they were above average for industry expansion. And then we also looked at the ESG score, because we know that a company's balance sheet is not enough, but rather companies need to be resilient in the face of ESG risks. So we used a minimum score of 52 points, drawing from MSCI Sustainalytics and LSEG ratings of each company's sustainability performance. And these ratings help us to understand not just how a company is doing today, but whether it's ready for the challenges ahead. And once we have our list, we go deeper, analyzing historical trends and ESG adjusted forecasts to see how sustainability factors might impact future earnings, margins, and overall risk exposure. I'll now pass it off to Suniti, who will go into further depth.
To build an ESG-focused portfolio, we use MSCI Sustainalytics and LSEG ESG scores, which is also known as Refinitiv, and each of these offer a unique perspective. The MSCI ranking ranks companies from AAA to CCC, assessing industry-specific ESG risks and management quality. Sustainalytics focuses on financial exposure to ESG risks, considering material issues and governance quality. LSEG provides a 0 to 100 score based on 10 ESG themes and more than 870 factors from public data. These scores give us a strong baseline, helping us compare companies across industries. But ESG scores alone don't tell the full story. So, to refine our approach, we developed our own ESG scorecard, adding layers of evaluation to ensure we invest in companies that are not only scoring well, but are truly prepared for the long-term sustainability. So we can now see the scorecard in the next slide, where our ESG scorecard builds on third-party ratings, but goes further, integrating weighted scores from MSCI and all of these other two ESG scores, alongside other key factors that influence a company's long-term performance. Instead of treating all ESG risks the same, we apply industry-specific weightings, ensuring we focus on the most material risks in each sector. We also factor in climate impact metrics, regulatory compliance, and financial stability, giving us a well-rounded view of the company's ESG readiness. At the bottom of our scorecard, we break performance into 4 key dimensions, which is risk exposure, multidimensional ESG evaluation, climate impact, and regulatory alignment. This structured approach allows us to go beyond surface level ratings and evaluate companies in a way that align with both financial returns and long-term sustainability. By using the scorecard, we ensure our portfolio isn't just made up of companies with high ESG scores, but also of businesses that are truly prepared for the challenges and opportunities ahead. Next, we move on to the stock filtering criteria. So before a company makes it into our portfolio, it has to pass a rigorous financial and ESG screening. So firstly, we make sure that we don't have any company which does not have net zero goals. We also ensure that our ESG scores are high. As Sydney mentioned, it has to be a minimum of 52. We then assess PEG ratio, forward PE, and P to E, and revenue growth to ensure strong financial fundamentals. Companies must also meet our companies, as I mentioned, must meet our minimum ESG score. Beyond the scores, we consider sector growth, trends, and macroeconomic factors, selecting companies that aren't just performing well today, but are positioned for the long-term success. This process ensures that every investment in our portfolio is financially strong, ESG conscious, and built for sustainable growth. I'm now going to hand it off to Patrick to take you through the Canadian sector exposure.
As the team has mentioned, it's important to understand the industry growth and sector dynamics. This will help us align our portfolio with Canada's economic structure and growth potential. From our assessment of Canada's market depth, the top 5 sectors in the S&P TSX Composite are financials, energy, industrials, materials, and information technology. Further, the top 5 contributors to the Canadian GDP in 2024 were industrials, consumer goods, real estate, materials, and healthcare. Building on this sector analysis, we also assess high growth opportunities within the Canadian economy, identifying pivotal high growth subsectors that are on the left, including agriculture, on the right, that include agriculture and food, clean tech, advanced manufacturing, just to name a few. We have carefully integrated these insights into our portfolio strategy to capture emerging opportunities while also maintaining alignment with the broader market trends. With that said, I'll pass it off to Azugo to dive into our portfolio sector allocation.
Like Patrick just mentioned, our sector allocation does not completely mirror the index or the Canadian economy currently, as we factor in the growth potential. And so we make sure we keep ourselves in utilities and energy for the clean tech opportunity, as well as consumer goods for the agro and food, and other industries like technology for the digital industries. And so we're sticking to 10 sectors, combining consumer staples and discretionary with an allocation of plus or minus 15%. But now let's move into the portfolio construction itself. As earlier mentioned, our criteria for selecting stocks starts with all companies having a net zero target, and we factor in our ESG score. Here we just use the MSCI and the Sustainalytics to summarize some of the components of that score. And then we incorporate the financial ratios to show that the company has a growth trajectory. As the company highlighted here, Rogers, has a PE of 13.83, which is significantly ahead of its market. Further going down, we go to look at the financials, and we want to incorporate our ESG assumptions within those numbers to see how it will affect revenue growth and whether it will accelerate it, whether it would have an effect on profit and margins or increase their growth rate, how it affects liquidity and solvency, and how it can help us forecast numbers that are cognizant of ESG risk. Ultimately, all the stocks that are selected would have to be rebalanced as we maintain a constant weight portfolio that we trade periodically to rebalance it based on market conditions and technical analysis. To see a breakdown of our portfolio, you would see that we have covered the gambit of sectors within the TSE. We have made sure that we've stuck to our ESG ratings, and that we even have some integrated stocks and some short selling to make sure that we're targeting our better of one. All of this helps us in our portfolio analysis to come up with an expected return that is advantageous to our clients who want a strong risk-adjusted return. It also helps us to include the standard deviations in the next slide to be able to capture our risk and to also be able to capture what the actual loss potential would be with the value at risk or the expected shortfall. And finally, the Sharpe ratio, which is basically what we wanted to use for our risk-adjusted return after removing our management fees. All in this is to make sure that we are able to provide alpha, and we believe that this is achievable with a conscious ESG strategy. And so we will have Keshiv explain how we make sure with our engagement, we can put that in place in the companies we invest in.
Great. So looking ahead, our team has developed a comprehensive engagement strategy to address ESG non-compliance. This bottom-up, multi-layered approach ensures that we are proactively engaged with portfolio companies, leveraging industry networks, and using shareholder influence to promote responsible corporate behavior. At the core of our strategy is direct engagement. We plan to hold formal ESG review meetings to address performance concerns, establish clear benchmarks, and set time-bound expectations of 12 to 24 months to track measurable progress. Beyond direct engagement, working with industry networks like the CEC and the RIA allow for the adoption of best practices and partnership development. If companies fail to show progress, leveraging tools such as proxy voting to challenge management decisions can also formally address ESG concerns. Finally, if all engagement efforts fail, we plan to consider divestment, ensuring our fund remains aligned with responsible investing principles. This structured approach balances engagement with accountability, ultimately driving ESG improvements while promoting long-term financial value. We've gone ahead and summarized our portfolio strategy and investment policy statement here. Please feel free to pause and read it as appropriate. And that concludes our presentation. Through a disciplined investment strategy, ESG integration, and proactive engagement strategy, our portfolio is well positioned for the long-term growth and responsible investing. On behalf of the Munk-Rotman Green Capital team, thank you very much for your time.